gave up managing billions to become a better investor. Episode 19, Corporate Earnings Season Excitement. Hello. Yes, it's the start of the corporate earnings season this week, and it's going to be busy, but it's also going to be exciting too. And the thing is, it doesn't really matter whether you're a macro investor, a sort of a micro stock picking investor, whether you're multi-asset class oriented, or even if you actually buy third-party funds. The corporate earnings season is going to tell you an awful lot that's kind of useful for all investment styles and forms and related. I'm going to sort of observe that there's kind of two or three reasons why the corporate earnings season needs to be perceived in a certain manner, really. And I say that because I think a lot of people sort of simplify it to the notion that have stocks beaten or missed expectations? How much has FTSE 100 or S&P 500 companies, what are their revenues? Have they gone up or down? What's happened with their earnings, growth and related? And people sort of seem to sort of naturally think, well, if we've beaten expectations and things are going up, alternatively you've missed expectations or earnings are going down, then it's either a fantastic or a disastrous period as relevant. Reality is, and we've talked about this a number of times in this podcast, is that investment is a medium-term game. It always is. We all know that, but it's always also a forward-looking area. And consequently, even though whether you beat or miss expectations seems important, or whether you are seeing sort of improving or reducing revenue or earnings or other corporate numbers, reality is far more important from the corporate earnings season is to hear all of that, what I would call alternative information insights. Because the wonderful thing about the corporate earnings season is that you have companies from many different sectors across many different geographies giving their views. And certainly as an investor, that is so unbelievably helpful. As I say, irrespective of whether you're a macro or a micro or somewhere in the middle sort of investor. And I say that because nothing exists in a vacuum. That is such an important thing to remember, which people forget. And consequently, even though your own portfolio may be very focused on a particular, let's say, shares listed in a particular country or in a particular sector, or even in a particular individual company maybe, even if they are performing well and seem to continue to be performing well, nothing exists in a vacuum. And consequently, you need to have a feel for what the broader economy is doing. This is why, going back to my previous comment, that you should be spending 25% of your time on macro matters and about 75% of your time on sector and stock issues. And it's kind of interesting I say sector and stock, because I think, again, that's another area that people don't spend enough time thinking about. And I know that the world is a complex place and it's easy to spend too much time on macro issues. And as I say, about 25% of your time is about right in my expectation. But equally, I think on a sector and stock perspective, you have got to spend a good amount of your time doing sector analysis too, even in actually sectors that you don't invest in. And similarly, you should be listening to conference calls or reading transcripts or other earnings season insights from companies that you are not invested in. You shouldn't just be focused on the companies that you are invested in. Whilst, yes, you should be trying to initially primarily focus on those companies. Of course you should. They're the ones you own, and consequently you should be focused initially on them. But spend your time, a little bit of time each day and certainly each week, on different sectors that you're not invested in, and hence leading companies in those sectors too. And if you don't do that, you don't get that kind of feel for the overall market. Because again, we come back to this notion that if, let's say, lots of people like a particular sector or like a particular company, a good amount's going to be priced in. And we come back to the notion which was given, said to me by Mr. X 25 odd years ago. I talked about this in a previous podcast, that the most important thing is to know more than 90% of investors about a share. And even though that seems tricky, impossible to achieve, believe me, as I talked about on that on one of my previous podcasts, it actually isn't that difficult at all. So long as you work hard, do some insights, and actually in today's world, do stuff like listening to the conference call, thinking about what the company is saying, perhaps using some of your previous analysis and analytical work that you've done, and trying to work out really what is the important conclusions from this press conference, from this latest set of numbers? What does it mean for the future, and hence whether a share is expensive or cheap or not? But the reason why taking a step back and thinking about broader sector matters, and actually a wider range of company and also geographic issues and insights, is because nothing exists in a vacuum. Lots of insights sort of come into play from thinking about it in that perspective. From that sort of view, what are the sort of the 10 key sectors to look at? Let's think about it from a sector perspective first. It's kind of interesting. I've got in front of me a list of the Stock 600, 10 different indices. Stock 600 is pan-European measure, but frankly, it's pretty indicative of what I would imagine most stock markets, global stock markets have in the world. So the top 10 sectors are, in no particular order of size or importance, the 10 sectors are basic materials, cyclical consumer, non-cyclical consumer, energy, financials, healthcare, industrials, technology, inevitably, real estate, and utilities. Now, undoubtedly, you'll listen to all of those and thinking, yep, heard of all of those, have some thinkings about them or what they sort of stand for or mean within the broader economy. And certainly if I look at that list, I think to myself, over the last 10, 20 years or so, it's a pretty normal, regular kind of list. But I kind of feel it's sort of a little bit wrong, actually, thinking about today's investment world, even more importantly, thinking about tomorrow's. And as I've talked about before, the key for any investor, particularly those who perhaps have a number of years before their pension fund reaches maturity, they reach pension eligible age or something like that. You've got to be thinking medium term, and I think that means thinking more globally, and certainly probably thinking about markets in a slightly different manner, particularly if you're, as I say, someone who perhaps wants to pick and choose their own stocks and related. And on that basis, I'm going to give you actually my personal 10 sort of sector split of the market. And even though, again, it's not done in any particular order, in fact, what I'm trying to do is to sort of indicate to myself what the differences are with the Stock 600 split. Hopefully it's insightful and gives you something to think about. But as I said, the most important thing with corporate earnings season is to listen. And to listen and to read from all the updates out there. And I say, the wonderful thing about today's world is so much information is available, which maybe certainly 15, 20 years ago was not as easily applicable or accessible. Such is the benefit of the internet revolution and related, I guess. Anyway, back to my 10 sectors. So Stock 600, their first sector they mentioned was basic materials. I've actually slightly broadened that a bit. And I guess it's a reflection of the fact that you should be thinking about a broader range of commodities in the same sector. Because as you see from the Stock 600 list, it has basic materials and energy, two separate different sectors. And I think in today's world, you've got to have one combined sector. So I've called it materials / agriculture, which includes, yes, oil and gas, yes, mining stocks, yes, gold stocks and related, but also agricultural stocks. And I think in terms of thinking about investments, these are areas you've got to think about together from a broader sort of sector perspective. So that's my first sector. So I've already chopped down, if you like, the Stock 600 list down by a net one level, but inevitably I'll be adding different sector areas in due course as well. Area 2. So Stock 600 called this non-cyclical consumer stocks. I actually think that consumer stocks need to be given more allocations. As you may recall, Stock 600 index has cyclical consumers and non-cyclical consumers, and you can get the gist of what they're trying to do and the reasons why they've done it. That's absolutely fine. But from my perception, is the consumer zone is becoming more and more important. It doesn't matter whether you're a developed economy, developing economy, believe me, it's becoming super material. And consequently, I think you need a little bit of different ways to think about this broad consumer sector. So my second sector is what I call retail / travel, which is a a pretty obvious split. So retail, we can all guess as consumers if we visit a shop, and related travel on an akin manner. So retail stroke travel is my first one. The other one is the perception of consumer goods, and consumer goods is another very important way to think about the consumer sector, because there you've got more the companies that are supplying to the retailers, or perhaps to things that you would buy in the shops directly yourself, or maybe online a bit more nowadays. And I think having that different orientation, if you like, two different ways of thinking about the consumer sector, and we've got some other consumer related matters coming on a little bit later, is far more important than the old school way of cyclical, non-cyclical. The world's getting much more mixed up. And it's not just because of cost of living crisis and related, although that's a good indication of some of that. But what's far more important is understanding, does a company have pricing power? And particularly if they're a consumer facing company, that is so super unbelievably important. So as I said, my sort of two kind of consumer choices are retail stroke travel and consumer goods. The next one on my list, which has, again, some closer to, in today's world, affiliations with the consumer economy, even though it's going to be called industrial stroke building zones. In today's world, as I say, there is a much sort of closer interaction of many sectors in the world. And I think for me, that's a far better way of thinking about matters, rather than perhaps the historic list of just industrials. But I think by including industrial stroke builders, you kind of get that sort of house market kind of angle to it, which I know has been such a huge focus of many people in their general investment allocations, as well as perhaps what they've been doing or not been doing within the stock markets. So I think that industrial stroke building kind of split is also an important sector to have. And let's face it too, not all the economy by definition is consumer. We've already mentioned the agricultural space for historic thinkers, but clearly the Industrial Revolution, super important 300-400 years ago, and obviously materially important for any economy, particularly during the early stages of their development. Clearly, I would agree, in today's world, it's harder to differentiate between some consumer and industrial issues. And of course, we've got a different sort of broader split as well of economies with the rise of the technology sector, which I guess many would regard as a fourth area to think about markets. It's not just agriculture, industrial, consumer, there's technology as well. I kind of agree with that. I remember when people first started talking about that 20 odd years ago or so, and that kind of feels kind of right. But we'll come on to technology inevitably in a few moments' time. So we've got 4 sectors now. Number 5 is the inevitable financials. Financials, of course, is a broader church than many would think. It's not just banks. You've got to be thinking about insurance companies as well. You've probably got to be thinking about investment companies too. But certainly in terms of banks, in insurance and related sort of areas, it's still an important part of the economy. We'll come and talk about later in terms of some broad allocations I've currently got in my portfolio, and you'll see that actually I think for today's investor, there's probably other areas that you can find a bit more interesting. But anyway, we'll come back on that a little bit later. Next one up is something which we already mentioned in the Stock 600 list. They've called it healthcare. I've called it pharmaceutical on the basis that I can actually remember that a bit more easily. But clearly, healthcare, pharmaceuticals, it's the same sort of thing. It's, again, much broader than people think. It's not just about companies who are developing some new drugs and related. There are a number of different areas there. Clearly, and this is where it gets tricky, there's a number of companies in that space that has significant consumer orientation too, for obvious reasons. After all, let's face it, pharma companies, it's not just sort of selling ideas, although some are oriented that way. Most of them are centered on actually selling a product. And so hence why certain, what we would perhaps historically have called pharmaceutical companies, would now be appearing in different parts, let's say the consumer goods and related areas. But again, that shows you the nature of the importance of looking at different sectors, but also understanding, as we'll talk about in a couple of minutes' time, that actually some sectors are so difficult to try to kind of identify that you've got to create some new kind of slightly broader targets to capture them. Technology is next up. It's a pretty obvious one. Again, can be a broad church, but I think we all have a reasonable view for what is a technology company or not, although it's much more broader than just perhaps dot-com boom times or related 20, 25 years ago. I would still have utilities as a separate sector. Utilities, though, does include, it's not just gas and electricity companies to your home or something. Telecoms, of course, is a part of that, among other areas. Clearly, certain infrastructure and related matters certainly can be included here, although, again, infrastructure is something which isn't always directly listed. Sometimes it's private equity companies holding those sorts of areas as well. But certainly anything of a overt infrastructure orientation, which is of the kind of utilities-esque sort of zone, should be sitting in this space too. So I've got 8 here. You'll notice that as I talked earlier, I kind of combined, if you look at the Stock 600 list, the sort of basic materials and energy, I combine those into one for that kind of mass commodities, including agriculture space. So that gave me one gap. I've also dropped the Stock 600 index talks about real estate. Honestly, I mean, two observations. First is that I have mentioned real estate a few minutes ago, thinking about how, be it building stocks, industrial stocks and related, anything which is sort of overtly centered on that space can be included there. But frankly, real estate, as I'm sure many other people in the investment space have also said to you, to me, a home is a place to live. People investing in real estate aggressively, it's a slightly different church, certainly a slightly different allocation. I'm not convinced that it should equally normally, effortlessly be sitting in sort of a sector split of a stock market allocation, an equity allocation. But hey, some people have different ideas on that. As you can see, I've kind of dropped it, or at least certain elements of it kind of fit into other sectors. So I've only named 8 there. What are my other 2 areas to think about? And this is where I think it's starting to reflect the sort of the notion that the 2020s into the 2030s, the world is shifting and changing. Frankly, it has been for a long time. But I think that Stock 600 link sector list, that's why I think it's slightly erroneous, because I think actually the world is a bit broader and deeper. And there's some companies who are so tricky to say, is it an industrial name? Is it something in the consumer space? Or does it sort of sit elsewhere? So the first of these areas is what I'm calling facilitation. And by that, I mean, it's companies that allow you to either you as an individual, or maybe even more importantly, allow companies to achieve whatever they're doing. And you see this a lot with the fact that so many sales elements, companies are being given their supplies, provided with the goods that they are selling, or having their goods distributed to the companies that are selling their products, or something like that. That sort of distribution, facilitation kind of area, that's becoming more and more important, particularly as an economy becomes ever more consumer-centered. I guess to some extent, as we get both not just going to the shops, but having companies sell things online and related. And certainly it has become a more important part of, I think, many portfolios or different markets. Certainly, interestingly, and I put this as a side observation, when I look at on my own personal split of my personal pension fund, it actually is the sector or subsector which actually has the biggest proportional allocation. So there you go. Maybe it reflects something I'm particularly exposed to or interested in. But to me, I think it's important. In my next podcast, I'll be telling you a few more about some of these names and ideas and whatever. But there you go. Facilitation. Final one is what I'm calling sort of multi-asset. And I'm calling it that because multi-asset, you often do get companies which are difficult to allocate, mainly because maybe they have certain sort of different allocations within them. And I wasn't going to particularly mention specific companies in this podcast, but I'll probably have to mention it just to sort of observe the point and make the point. But if you think about it from, let's say, a UK FTSE 100 perspective, names such as Rolls-Royce or Johnson Matthey or companies like that, these are companies which actually have a range of interests, some of which, take Rolls-Royce, for example. Rolls-Royce I talked about the potential to have a sector called retail/travel. Well, clearly, Rolls-Royce has an angle there. You could call it that. You could also call it something sitting in the industrial area. Absolutely. Defence has its own sort of side angle to it as well. And quite where you put defence in is an interesting space. Generally, it's been in the industrial area, but Rolls-Royce, with its defence allocation, with its defence exposures, its exposures to travel engines and related matters, it's a difficult company to allocate. Johnson Matthey is a very similar name in the sense that you could certainly make it a commodities company, an industrial company with certain chemicals, observations and orientations as well. Chemicals, again, is a tricky sector generally to find where do you allocate a company to. And so for me, when that sort of multi-asset class area is, I think, very indicative of those sorts of companies. And so that makes number 10 on my list in terms of my 10 ways to think about a sector, different sectors in the markets. And the reason I'm telling you all of this is that I think it's super important to make sure that you're spending a bit of your time within the corporate earnings season period, actually looking at all 10 different sectors. And I say that because you should be diversified as an investor, even if you're just a stock picker. And as I've said about before, because nothing exists in a vacuum, if you only have allocations to one particular sector, one particular type of company, even to some extent, one particular geography, although that's a bit less of a problem. Let's face it, many companies may be listed in the UK, but at international selling in terms of their revenue bases and related. It's good to be diversified. It's good to be generally diversified. I mean, after all, what has been a great stock pick, for example, suddenly turns bad for whatever reason, but you have 70% of your portfolio in it, there's a problem. For me, as I may have talked about before, my personal view is even on stocks that I'm actually feeling passionate about, I think they're inexpensive, they've got great potential, even if they've already started to move and perform for me. If I get to above about a circa 10% level of my portfolio, that's a bit too much for me. Above 10%, I'm starting to feel very uncomfortable. Sure, if let's say there's a takeover bid and it goes from 7% of your portfolio to 10.5%, and you're thinking, well, okay, maybe I'm going to think about what to do here. That's a sort of an easy one, but it's the ones where perhaps a stock continues to perform well. It goes from 6% one year, then it's 8% the next year, then it's 9.5%, and then it's 10.3%. And thinking, this has been a great winner for me for ages. I'm still feeling I'm still feeling excited. I still think there's opportunity. What do I do? Take a few early profits. There's no negative in taking an early profit, and you can still carry on holding some of your shares. I think in one of my early podcasts, I talked about my biggest proportional share win as an investor, and I took some profits early. And what's bad about that? Profits are profits after all. And even though you should always be looking forward as an investor, taking some early profits, it's not a bad thing. No bad thing at all, particularly if you're saying, look, I'm just making sure that I keep an under 10% allocation. It's not as if you haven't got any share allocation there at all. I think what gets more interesting is thinking about those sector splits. Now, you think about those 10 sectors that I've mentioned in my own personal list. Let's go beyond the Stock 600 top 10 areas. Let's think about my top 10 areas. On a sector allocation, I feel uncomfortable if I have more than 20% allocated to any sector. Now, clearly, that may mean that you have 2 or 3 holdings of getting, 7% or 6-7% or something, or it might be sort of 2 10% positions, or maybe 4% positions, whatever the split is. I think you shouldn't have more than 20% allocated to a single sector. Now, I know what you're immediately thinking. You're thinking, well, okay, but let's say, look at how the NASDAQ has performed. Look how the tech stocks have become a massive part of the S&P 500, even the Dow 30 in the States. And look at the performance over recent weeks and months and related. But then for every strong period of performance, and of course this is, I guess, a view kind of built during my formative years in the sort of the late part of the last century, the early part of this century, with the dot-com boom and bust, I guess, you can allocate too much to a sector. And for me, 20% is enough. And I'd still say that for technology today. I know that there's going to be controversial. There's going to be people saying, look, technology is a broad church. It's developing in exciting ways for us all in many different manners. And consequently, having much more than 20% is absolutely fine. I disagree. I say that because actually some of the key reasons why perhaps technology is fully impactful upon our lives is that you've got sort of impacts on all different sectors. I mean, the internet's a great insight, sure. Back in the days of the dot-com boom, anything mentioning internet was ticking the box. Oh my goodness, this is so next generation, so exciting. Clearly, tech per se, however tech was defined then, did remarkably well. But of course, any other company with some linkage was also getting benefit from it. And we've seen something not wildly dissimilar actually with AI over recent months, where actually it's interesting, over at the last sort of conference call insights that I had after the first quarter, I saw that, thick end of 90-something% of conference calls during the last earnings season mentioned AI in some shape or form. And it was fascinating to see companies, it's actually easier to see companies that didn't mention AI linkage in some way during their conference call. Again, an indication that AI enthusiasm was a bit too excessive and actually needed to chill a little bit and understand that it is something that's happening and changing. Frankly, it's been happening for the last 10 years or so in different ways, and will happen a lot more over the next 10 years. But don't anticipate that it tells you everything marvelously about what's cheap or expensive. So you've heard the fact that sectors are important for me. Earnings season is clearly super important, but you've got to think about sectors too. I've talked a little bit about how I think about the sector split in today's world. I've talked about the fact that having more than 20% of your allocations to a particular sector would be too much. Similarly, having more than 10% of your allocation to an individual stock in any sector is, I think, a bit too much too. I guess now the next question is, so corporate earnings season, what are you looking for? What do you want to get out of it? How should you think about these conference calls or reading sort of some of the thoughts from the earnings season? How can that be useful to me? What should we do from here? My next podcast is going to be based on that, just because this evening on Monday the 10th of July, we've actually got the first of what I regard as the first of the corporate earnings season numbers coming out. And I'm going to use that as a good insight into how I think about a company when it reports, and perhaps some indications about what you might want to think about over the next 5, 6, 7 weeks, when perhaps some of your favorite companies or the companies that you're thinking about give their updates, or you get the chance to read some of their thoughts from their conference calls. And we can go from there and sort of try and work out how to sort of make the most of the corporate earnings season for better, I think, much more than worse. So on that basis, thank you so much for listening in. Hopefully that's been of interest. But as always, I kind of, hopefully I've said something which is useful, and we can talk again later this week about the start of the corporate earnings season and how to actually think about, on a practical basis, what you should be looking for, how should you interpret stuff and related, and even more importantly, what decisions to make or not make as a consequence of the corporate earnings season insights. So thanks again very much, and speak to you soon. Bye-bye.